This is a lecture for Chapter 9, which covers property, plant, and equipment or fixed assets and intangible assets. We'll start with the fixed assets. All right, fixed or plant assets have physical substance. They're used in the operation of a business like machinery, and you are not going to sell them to the customers because you're going to need the fixed assets to operate the business. And because they represent a major investment, they are expected to be used by the company for a number of years. The next slide gives a listing of various companies and the percentage of their total assets that are fixed assets. And you can look at that, and that's also in the text. All right, the historical cost principle. This is one of the basic principles of the generally accepted accounting principles. So according to the historical cost principle, the companies must record their assets on the books at the acquisition costs. And the acquisition costs include all expenditures that are necessary to acquire the asset, to get it to the location where it will be used, and to get it ready for its entire use. So if there are any modifications that have to be made or special installation that has to be done. Also, just based on the historical cost principle, there would be no there could be no adjustments made for changes in fair market value. What we're going to have the next few slides is we're going to have the individual major categories of fixed assets, and you're going to see the components of the cost. So for land, you have the purchase price, closing costs, and they mentioned title searches and attorney fees, real estate brokers' commissions, and any accrued property taxes and other liens on the land assumed by the purchaser. So we have an illustration here. Hayes Company acquires real estate at a cost of $100,000. The property contains an old warehouse that is raised at a net cost of $6,000. So the cost was to raise it with $7,500, but then they get $1,500 proceeds from the salvage material. So that brings the raising of the warehouse down to a net of $6,000. Additional expenditures are the attorney's fees and the real estate broker's commission. So it says determine the amount to be reported as the cost of land. So if we go to the next slide, we have it. Purchase price of the land, $100,000. The net removal of the warehouse of $6,000. The attorney's fees of $1,000. And then the real estate broker's commission of $8,000. So the total cost of that land would be $115,000, and that is what would be reflected on the company's balance sheet. Right, now we have land improvements. Now, we had said that land is not a depreciable fixed asset. However, land improvements are. So they give you examples of land improvements: driveways, parking lots, fences, landscaping, underground sprinklers, also lighting, or any furniture that is attached to the ground outside. The land improvements have limited useful lives, so parking lots do have to be replaced. Fences do, landscaping does, and that we depreciate the cost of the land improvements over their estimated useful lives. Okay, so now we're on to our next category, and that is buildings. So the cost of the buildings, if it's a purchase, will be the price, the closing costs, the real estate broker's commission, and any remodeling, replacing, or repairing of the roof, floors, electrical wire, or plumbing that must be done before you can use the building. If you're constructing the building, then it would be the contract price plus architect fees, building permits, and excavation costs. The other thing that would be included in the cost of construction is if you have a construction loan, so that for the time during construction, the interest could be capitalized or added into the cost of the asset. Once the construction is complete, any additional interest expense would have to be expensed. Another category, equipment. So the components of the equipment cost: the purchase price, sales tax, freight charges, any insurance during transit paid by the purchaser, expenditures required in assembling, installing, and testing the unit. So we have an example. Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales tax of $1,320, painting and lettering of $500, motor vehicle license of $80, and a 3-year accident insurance policy of $1,600. So if we look at the cost of the truck, the price would be included, the sales tax, and the painting and lettering, to give us a total cost of the truck of $23,820. The motor vehicle license of $80 is not part of the cost of the truck. First of all, that would be the license for the individual, but it is a regular expense that is incurred every few years. Also, the insurance policy. That is something that people have to carry on their vehicles. Has nothing to do with the cost of the truck. That is an ongoing operating expense. So therefore, it's not figured into the cost of the truck. And now we see the journal entry that Leonard would make to record the purchase of the truck, the license expense, and the prepaid insurance, because they're prepaying 3 years of insurance up front. So we'd be debiting equipment for $23,820, debiting license expense for $80, debiting prepaid insurance for $1,600, and then the total cash outlay of $25,500 would be credited to cash. Now we have to make a distinction between ordinary repairs and additions and improvements. So ordinary repairs are expenses, they're revenue expenditures. So ordinary repairs are ongoing expenses that are incurred to maintain the operating efficiency and the productive life of the unit. So for the delivery truck, an example of a maintenance expense would be an oil change. Additions and improvements are costs incurred to increase the operating efficiency, productive capacity, or useful life of a plant asset. So this is a capital expenditure, and it would be depreciated. So if we go back to the delivery truck, let's say that we replace the engine. The engine would be considered a capital expenditure because it would increase the productive capacity of the truck and its useful life. There is a cost associated with capital expenditures or fixed assets, and that's depreciation. And we looked at that when we discussed adjusting entries. So depreciation, as the slide indicates, is a process of allocating to expense the cost of a plant asset over its useful life in a rational and systematic manner. So in other words, when a company buys a fixed asset, they're buying the future benefit that they're going to get from using that fixed asset. So then what they're going to do is, as they receive that benefit, they're going to expense a portion of that fixed asset in each accounting period during its estimated useful life. Now, so the first bullet says that depreciation is a means of cost allocation. It is not asset valuation. And it also says that everything is depreciable except land. Right? And the assets are depreciable because the revenue producing ability of an asset will decline over the asset's useful life. So there are three terms that we need to familiarize ourselves with, and these are the three components that go into calculating depreciation. And we're only going to look at one method, and that is the straight line method is the most commonly used method. So the first thing is the cost. So all expenditures necessary to acquire the asset and to make it ready for its intended use. And we've already said that. Useful life, it is an estimate of the years of service that a business expects to get from its fixed asset, and it's based on the need for repair, service life, and vulnerability to obsolescence. And if you think about technology, particularly computers, we know that they become obsolete quite quickly. And then the salvage value, it's also referred to as a residual value, is an estimate of the asset's value at the end of its useful life. That salvage value may be right on in terms of what the owner can get for the asset at the end of its useful life, or they may get less, they may get more, they may get nothing. Right, this pie chart just shows, it's based on a survey, that 83% of companies use the straight line method of depreciation, and the reason for that is that it is the easiest to use. So we have an example here. We have Barb's Florist purchased a small delivery truck on January 1st, 2017. And they're asking us to compute depreciation using the straight line method, units of activity, and declining balance. We're only doing the straight line method. So the information that we're going to need for our purposes would be the cost of $13,000, the expected salvage value of $1,000, and the estimated useful life of 5 years. So we have the calculation for depreciation using the straight line method. First thing we have to do is we have to come up with the depreciable cost. So we take the cost of the asset, $13,000, subtract the salvage value of $1,000, and that gives us our depreciable cost of $12,000. We then take the $12,000 and divide by the estimated useful life of 5 years, so that the annual depreciation expense will be $24,000. Now the book value of the asset cannot go below the salvage value. And in order to calculate the book value, we will take the cost of the asset, so in this case of $13,000, and then we will subtract the balance in the accumulated depreciation account. I have a table in the next slide in which the publisher has computed the book value at the end of each year. So if you look at what they did here, they have $12,000 times 20%. That is the same as dividing by 5 years. You're going to get the same thing. The way they came up with that 20% is they took 1 year divided by the estimated useful life of 5 years. So that gives us a straight line rate of 20%. Alright, so at the end of the first year, because we've recognized 1 year's worth of depreciation, we have accumulated depreciation of $2,400. If we subtract that from the cost of $12,000, we get a book value of $10,600. In year 2, we recognize another year of depreciation of $2,400. Now, the accumulated depreciation account has a balance of $4,800. Once again, we're going to subtract the balance in the accumulated depreciation account of $4,800 from the depreciable cost of $12,000. So now, at the end of year 2018, we have a book value of $8,200. In 2019, we recognized another $2,400 of depreciation expense. We're going to add that to the balance of $4,800 in accumulated depreciation. And now the accumulated depreciation for 2019 is $7,200. And we subtract that once again from the acquisition cost of $12,000, and that gives us an ending book value of $5,800. For 2020, we recognize another year of depreciation of $2,400. We add that to the balance of accumulated depreciation for 2019, and now at the end of 2020 we have a balance of $9,600, which we subtract from the cost of $12,000, and we have a book value of $3,400. Finally, in 2021, we recognize $2,400 in annual depreciation expense once again. Add that to the accumulated depreciation balance of $9,600, and we have a balance in accumulated depreciation of $12,000. If we subtract the $12,000 from the acquisition cost, it's not the depreciable cost, the acquisition cost of $13,000, we have a balance of $1,000. Alright, so let me just correct myself. In every situation where I said we would be subtracting accumulated depreciation from $12,000, that is not correct. We're subtracting accumulated depreciation from the cost of $13,000, the purchase price of $13,000. Now, the asset cannot have a book value below the estimated salvage value. So as long as this company continues to have this asset and is using it, the book value will be $1,000. Alright, and this slide we're going to skip, so don't even worry about that. Alright, now we have to consider three scenarios: sale of a fixed asset, retirement of a fixed asset, and the exchange we're not going to do. So in terms of sale, we're going to have to look at what the gain or loss may be as a result of a sale of an asset, but also retirement. If an asset is just thrown away, is there a loss there? So the first thing we need to do is to record depreciation up to the date of disposal, so that the book value and the accumulated depreciation account will be correct. So when we make a sale or we retire an asset, for that asset that we're getting rid of, we're going to be debiting accumulated depreciation or zeroing out that balance and crediting the asset account. Right, so for retirement of plant assets, no cash is received. So we're going to decrease or credit the asset account, so that goes away, and we're going to decrease or debit the accumulated depreciation account, and that also goes away for that asset. Alright, so in this situation, Hobart Enterprises retires its computer equipment, which costs $32,000. The accumulated depreciation on these printers is $32,000. So we need to prepare the adjusting entry to record the retirement. So we're debiting the accumulated depreciation, crediting equipment of $32,000. Since the balance in accumulated depreciation and the balance in equipment are equal, there's no gain or loss on the retirement of that asset. Now we have another situation. We have Sunset Company discards delivery equipment that costs $18,000 and has accumulated depreciation of $14,000. So this time we're debiting accumulated depreciation for $14,000. We credit equipment for $18,000. So therefore we have a loss on the disposal of the asset of $4,000. And companies will report report that loss under other expenses and losses on the income statement. Alright, so now sale of plant assets. In order to determine whether or not we have a gain or a loss on the sale of plant assets, we're going to compare the book value of the asset to the proceeds received from the sale. So if the proceeds are greater than the book value, we have a gain. If proceeds are less than book value, we have a loss. So here is an example of a problem. On July 1st, 2017, Wright Company sells office furniture for $16,000. The office furniture originally cost $60,000. As of January 1st, 2017, it had accumulated depreciation of $41,000. Depreciation for the first 6 months of 2017 is $8,000. Prepare the journal entry to record depreciation expense up to the date of the sale. Alright, so we have to, depreciation was recognized up to January 1st, 2017. The sale is occurring on July 1st, 2017. We need to update that accumulated depreciation account. So we're going to debit depreciation expense and credit accumulated depreciation for $8,000. So we have the calculation of the book value. We have the original cost of the furniture, $60,000, the accumulated depreciation, so we have the previous balance plus the additional $8,000 that we've recognized. So the accumulated depreciation account has a balance of $49,000, and so therefore the book value is $11,000. The proceeds from the sale are $16,000, so we have a gain on the disposal of the asset of $5,000. So the journal entry would be to debit cash for the $16,000, debit accumulated depreciation for $49,000, credit equipment for $60,000, and credit gain on disposal of plant assets for $5,000. Alright, let's look at another scenario. We're taking the same basic fact pattern, we're changing the proceeds. So book value is the same. Now the proceeds are $9,000. We're going to have a loss on the disposal. So we'll debit cash for $9,000. Debit accumulated depreciation for $49,000. Credit equipment for $60,000, and then debit the loss on the disposal of plant assets for $2,000. Alright, one more example. Overland Trucking has an old truck that costs $30,000 and it has accumulated depreciation of $16,000 on the truck. Overland has decided to sell the truck. What entry would Overland Trucking make to record the sale of the truck for $17,000 cash? So we're going to debit cash for $17,000. Debit accumulated depreciation on the truck for $16,000, credit equipment for $30,000, and we have a gain on the disposal of that truck of $3,000. Alright, we have the same fact pattern, but this time we're changing the proceeds. So this time they're selling the truck for $10,000 cash. We're debiting cash for $10,000, debiting accumulated depreciation equipment for $16,000, crediting equipment for $30,000, and then debiting a loss on disposal of plant assets for $4,000. So that concludes our presentation on fixed assets. Now we're going to go to intangible assets. Now the fixed assets we said have a physical substance. Intangible assets do not have a physical substance, but it does not mean that they are not worth anything. So if you look at the general definition that we are given for intangible assets, they're rights, privileges, and competitive advantages that result from ownership of long-lived assets. They may have a limited life or they may have an indefinite life. The common types of intangibles are patents, copyrights, goodwill, trademarks and trade names, and franchises. And there is a slide dedicated to each one of these. First of all, I'm going to go through the accounting for intangible assets. You're not going to actually be doing this. I just want you to know what it is. So for the limited life intangibles, you're going to amortize to expense. So with fixed assets, we had depreciation expense. Now, with the intangibles, we're going to have amortization expense. And then the asset account itself will be credited or reduced. So what we did with fixed assets was we credited accumulated depreciation instead of the asset itself. With intangibles, we're going to credit the asset account itself. If we have intangibles with an indefinite life, then we are not going to be recording amortization expense. Alright, so the first classification of intangibles is a patent. It's an exclusive right to manufacture, sell, or otherwise control an invention for a period of 20 years from the date of the grant. So the costs of purchasing the patent are capitalized or recorded as an asset, and they're amortized or expensed out over a 20-year life or its useful life, which is ever shorter. Any R&D expenses incurred in developing the patent do not get included in the cost of the patent. They are expensed out. Legal fees that are incurred in successfully defending a patent are included in the cost of the patent. Copyrights. Copyrights give the owner the exclusive right to reproduce and sell an artistic or published work. The life of the copyright is the life of the creator plus 70 years. The cost of the copyright is the cost of acquiring and defending it, and the cost would be amortized since it has a definite life. Trademarks and trade names. So it's a word, a phrase, a jingle, a symbol that identifies a particular enterprise or product. So with CBS, we have the I. With NBC, we have the peacock. With Big Mac, we have the golden arches. There is a legal protection for that trademark for an indefinite number of 20-year renewal periods. So they have to be, the protection has to be renewed every 20 years ad infinitum. If it is not renewed, then of course it can no longer be considered protected. So the acquisition costs of the trademark or trade name are capitalized or recorded as assets, and there's no amortization expense. Alright, now we have franchises, and of course I'm sure you can think of quite a few franchises. I'm just thinking of Dunkin' Donuts and Jiffy Lube. So they're contractual arrangements between a franchisor and a franchisee. And they give you some more examples. A franchise is a license with a limited life, and it should be amortized to expense over its useful life. If the life is indefinite, then the cost would not be amortized. Alright, the last of the intangibles is goodwill. And goodwill is kind of a unique type of intangible. The accounting for this intangible has been changed. It used to be amortized or expensed out. It is no longer the case. The only time there's any adjustment to it is if it's determined that there's a permanent impairment to the value. So goodwill includes exceptional management, desirable location, good customer relations, skilled employees, high quality products, etc. So in other words, when a company buys another company or buys a segment of a corporation, what they're buying, among other things, are those items that are listed above. And the things that are listed are a challenge to put a price on. How do you put a price on good customer relations? So the goodwill is only recorded when an entire business is purchased, and that goodwill cannot exist apart from the assets that it goes along with. Goodwill is recorded as the excess of the purchase price over the fair value of the net assets acquired. Research and development costs. At one time, they could be capitalized or recorded as assets. However, it turned out that there was a lot of abuse. So now the R&D expenses must be, or the R&D costs must be expensed out when they are incurred. And that involves R&D costs that may result in patents, copyrights, new processes, and new products. That concludes what we're going to cover with intangible assets. We're not going to worry about the accounting for them. What's important for you to know is to recognize those intangibles and what they are. And when we get to the classified balance sheet, you will see where those assets will show up. All right, that concludes our lecture.